Welcome to the module Understanding Trend Lines. Here we'll tell you exactly how to successfully draw your trend lines properly and how not to draw them more crucially. And we'll also discuss why they're one of the most overrated technical instruments in the industry. Of course, as with anything, they've got pros and cons. Trend lines help us to project the future at where price action is likely to react to based on previous touches or bounces with price action. That's pretty obvious, as we'll demonstrate in a bit. And it shows that a trend line bounce which correlates or overlaps with a Fibonacci number, horizontal level, moving average, or psychological number is considered to be stronger compared to just a mere trend line bounce. As with all of our tools, if we're looking at a potential trade setup and we've got more factors pointing or correlating with each other, say we've got a trend line bounce overlapping with a moving average bounce and a Fibonacci number, that's going to be a lot stronger than if it's just a trend line bounce on its own. And as you might have heard us discuss before, we would never actually trade a trade just based on one factor. It would have to be more than two, or two at the very least. So a trend line overlapping with another technical tool is absolutely fantastic. Based on its own, it's not much. There are cons, of course, and the number one downside of trend lines, of course, is the subjectivity of them. If you're drawing a trend line, for example, which is a lot more psychologically based than, say, a horizontal level, which at least corresponds directly with price, you can find your trend line very differently drawn to the next person. And of course, when we're trading a market which is based on probability and weight of a particular argument, if we're going long or short, and we've got different trend lines drawn in different places, pointing to different areas, then that's going to create a market of relative ambiguity. And of course, when we look to trade, we want to look for the most watertight case possible to place the trade. And the less ambiguity we have in a trading decision, the better it is for our trade and for our confidence with taking that trade. And of course, the self-perpetuating nature of it. And as I just mentioned, it's best not to trade based on a trend line bounce alone. We want it to be aligned with something else, whether it's a big number, a horizontal level, a moving average, a Fibonacci number. So just in case you're unaware of a trend line is essentially a vertical line which joins up in an upward trend the troughs. So you can see here we've got the first touch, we've got the second touch, and the third touch. And as we've got kind of a trend between the points of intersection, we can draw in a line up with the areas to align all the troughs up together in order. The more touches or bounces or points of intersection, as we may call them, the trend line intersects with, the stronger the trend line is considered to be. So we would say that the first touch is all very well and good. The second touch is a coincidence, and providing if we're making higher highs and higher lows, with higher peaks and higher troughs and an upward trend, the third touch is where you might consider potentially going long, but ultimately you want to wait for the fourth bounce. That will give us confirmation that these points of intersection with the trend line aren't mere flukes. And of course, trend lines are served best in trending markets where we've got higher peaks and higher troughs. Higher peaks and higher troughs. So essentially, trend lines are synonymous with cyclicity and rising moving averages. Of course, you're not going to really get trend lines in a flatlining market where the price action is moving sideways. They're good for trending markets, whether it's an upward trend or downward trend. And in an upward trend, as a general rule, we line up the troughs, the higher lows, you might call them as. Whereas in a downward trend, we line up the peaks, the lower highs, essentially, like we'll discover in a minute. As we can see here, we've got good cyclicity. We've got lower highs and lower lows, and we can line up the lower highs here, or the lower peaks, as you might call them, with a trend line. So we've got 3 points of intersection, like we just mentioned. We've got the first touch, all very well and good. The second touch, which is a mere coincidence, and the third touch is where we can reasonably expect there to be a relatively high probability in it going down, but ultimately we would want the fourth bounce to trade off if we wanted to be very safe. The more touches a trend line has, the stronger it is, especially when it's correlated with cyclicity, i.e. we've got lower highs and lower lows, which is the important point. So you can call the touches on the trend line bounces or points of intersection, where the trend line or the price action has interacted with in order to establish a direction in phase one downwards. As those of you who've seen the module on cyclicity, we've got phase one going down, phase two retracing back up to the trend line, or it could be a moving average for that matter. We've got the phase one here and phase two, and what the trend line seeks to do is act as a psychological line in the sand, but where we can preempt the continuation of phase one. So in this case, making a lower low in a downward trend, or in an upward trend, phase one being making a higher high after we've got our higher low made intersecting with the trend line. So whilst trading the third bounce or the third touch of trend line is okay, it's forgivable, we would ultimately want to take advantage of the fourth bounce, because the more times a trend line has tested and been interacting with it, especially when it's a large of cyclicity, the more it gives us in terms of clues that it's going to happen in our favor. So, as I said, the first touch is all very well and good. The second touch is just a mere coincidence. Do not trade on the second touch on a trend line, because that's just a mere fluke. The third touch is where we can reasonably say, okay, this is a bigger argument that a trend line with cyclicity is building up here and it's been respected, but the fourth touch is our ultimate confirmation if we're looking at the trend line on its own. Of course, we would never really want to look at the trend line on its own. We could look for another technical reason to get into the trade, like we just mentioned, and certainly you could trade the third touch on a trend line bounce if we do have another technical reason, like you might have the third touch on a move on a trend line, but it could be the second touch also on a moving average as well. So in short, trading the third touch and the fourth touch on a trend line is absolutely fine, providing it's with another technical reason or another element of your toolbox. And similarly, the same case in a downward trend. We've got the first touch all very well and good, the second touch an absolute fluke. Do not trade on a trend line bounce short if it's just the second touch on this trend line. The third is absolutely fine, but not as good as if it's the fourth bounce on the trend line. As for the previous upward trend, trading the third and the fourth bounce on a trend line is absolutely okay, providing preferably you have another reason to go short correlated with it. So it might be another reason in our toolbox, like a moving average bounce, a Fibonacci rejection, could be a horizontal level, could be a big number. But the more reasons we have in our argument to go short, the better it is. And certainly just a trend line bounce on its own is not sufficient in our view. But if it's with something else, then fantastic. So in this example here, where we've got a confluence of a trend line, it increases the probability of our trade, whether it's long or short. And we're really going to draw this into your minds, with any technical setup, the more factors which overlap with the trend line or whatever technical indicator you're looking at, the higher probability your trade is. So it could be a moving average, rejection of a big number, rejection of a horizontal level, a Fibonacci level, or a weekly or monthly pivot bounce. So here, in this example, whilst we might have a low test bar which correlates with the fourth test of a trend line, we've also got the third test of the 20 moving average, which is fantastic. Because as you will discover, if you have not already, in the moving average module, if price action is above the 20 moving average, then of course it's got really good speed and momentum behind it. It's got good cyclicity here, making higher highs and higher lows. And if we've got the third test of the 20 moving average in addition to the fourth test of a trend line, on cyclicity, which is making key higher highs and higher lows like so, then we've got a very good likelihood that it's potentially going to make a higher high thereafter, having low tested off the 20 moving average, the trend line, in an instance where probability has proved in the past that it will be making higher highs and higher lows. And we appreciate this is a drawn example, so what we'll do now is we shall go to the real charts and show you for ourselves so we can apply it to the present. So in order to draw trend lines successfully, what we need to do is identify the common point of intersection. We've got Euro New Zealand right before our very eyes here. It's in a downward trend. The more data we have in order to make our judgment with the trend line, the better it is and the stronger our trend line is. So let's have a look here. We can see that there's a potential trend going down with these 3 points here. On the 11th of November 2003 to November 2011 and May 2012. So here we go. You can see we've just got a trend line here. For your information, this is where trend lines get quite ambiguous. Some people might have drawn their trend line like so, so that the 3 points are touching, which is absolutely fine. By the way, it's okay to have a little spike above the trend line. As long as it hasn't closed above the trend line, that's the important thing. If it hasn't closed above the trend line, you're okay. If it's spiked up above it, and we've got a tail above the trend line, but it has closed below the trend line, then that's absolutely fine. It's when we get a close above the trend line is where we can regard the trend line to be invalidated. Whilst we've got trend line resistance in this case, with our lovely phase 1, phase 2, phase 1, phase 2, phase 1, and now we're in phase 2, we can reasonably say that we're hurtling towards this trend line again before we can see another continuation of phase 1 again and down. So we're in a period of retracement at the moment. But even though we've got this trend line resistance here, what about the trend line support? We've also got a trend line on the bottom side, have we not? We do, yes, indeed. There we go. And we've got 4 touches on the bottom side right here. And this is actually a very strong trend line. 1, 2, 3, 4, as is the trend line resistance on the top side. And it's very seldom that we get trend lines this strong and this clear on the daily. However, on the shorter term time frames, they're a little bit more frequent. Certainly the hourly, the 15 minutes. However, as we're end of day traders, we don't really want to give a damn about those time frames, to be honest with you, or waste too much sleep agonizing over them. So as we can see here, we've got near perfect trendline touches on the trendline support on the bottom side, and near perfect trendline resistance on the top side where they've been tested. However, trendlines can often not be this clear, and what we want to do is basically give you a decent understanding of how to draw them when markets are not that revealing. Okay, so on Euro GBP here, we do have a downward trajectory, for sure, downward cyclicity with its lower highs and lower lows. What we're looking to do here to draw the downward trend line is take it from the very top, like so, look for the start of the move, and try and plot up these points on the bottom side here. We've got 2 touches. We could reasonably say, okay, it's intersected this trend line on this occasion here, but this is just the 3rd touch, and it hasn't interacted with this trend line since, well, 2011. However, what slightly more people will be doing is looking for a slightly more shorter term, more recent trend line. So what we could do is take this more recent points of price action, drag them down here. That's what we did. Let's zoom in here. And this is where trend lines can get a little bit ambiguous. And this is why we don't really treat them like gospel unless they're in correlation with another reason or factor which influences our trading decision in the direction of the prevailing trend. Here we've got 1, 2, 3 touches. We had the fourth touch here, which failed. Price action closed above this trend line, as you can see, and we had a higher low here. Do you remember what we said about higher lows? Those who've seen the module on cyclicity will say, or hopefully remember, that a higher low is a warning sign that the momentum is starting to change, and in this case, it's starting to change in favor of the bulls as we've got a higher low. The bears haven't been strong enough to bring price action down to a new lower low. So if we do simulation, at this point we were short of Euro GBP, and then we were in the long haul as it divided about, not really knowing what it was doing, and then we covered our positions. It made a higher low here, and all was okay, apart from when it decided to close above the trend line. That's okay. It's okay if we get a fake out, if you like a high test bar. The tail is outside the trend line, but the open and close is crucially inside the trend line. However, eventually, this happened. And when we get a break of a trend line, for example, close above the trend line, generally we do get a big move in that direction, upwards. Because it is, if the trend is starting to bend, it is quite potentially the earliest position that the bulls can get in and build a position contrary to the prevailing downward trend in advance of the perpetuation of the upward trend. I would say we're going to draw a trend line. It's far better to factor in the shorter to medium term, suffice it to say this trend line, rather than the longer term, which hasn't really been visited for quite some time. Some people would have been looking at this trend line, like so, drawn from these 2 points. Here, and they'll be looking at the fact that we've got the third bounce right here and waiting for a reversal. However, as we've got the higher low here, and the momentum looks pretty bullish, I personally would be looking to go short into this. However, you can see the ambiguity of trend lines. We've got some people, certainly in the market, will be looking at this as a trend line, like so. So what we'd always say is trend lines are absolutely fine, provided you've got another reason to get into the trade. Let's take a look at Swissy now. We can see that for the most part it's been making higher highs and higher lows here. We do have a trend line here, like so. Other people could potentially be drawing their trend lines here, trying to line up the more points and identifying the point of intersection right here. So hence the ambiguity. Certainly if you were to have drawn the first trend line, that trend line would have been broken and completely invalidated at the close here, as we've got a close below it. Certainly if we had the low test bar closing on or above the trend line, that would still make the trend line valid. This upward moving trend line, spanning over a decent period of time, about 9 months. So just to reiterate, it's absolutely fine if you get a spike below it like a tail. If it's a low test especially, in fact if it tests below and you've got a tail below the trend line, but the open and close is above it, then that's a very bullish sign actually. But as we can see, a low test followed by a high test is a bearish sign indeed, and here we go. The weakening dollar. However, some people who have drawn their other trend lines, or their primary trend lines like so, factoring in these tests, or these points of intersection here, would have found relatively recently that their trend line had been broken and invalidated because of the close below it, like so. So they've been in the game for a little bit longer than those people who would have drawn the previous trend line. However, this trend line is not as strong because it does not cover as longer amount of time as the first one did. Plus, in our opinion here, the first trend line intersected with essentially this horizontal level here, which is decent because if we are looking at maybe possibly trading the low test bar long here, a trend line is not good enough on itself. If you've got a horizontal level in support of this, then fantastic. If you've got a Fibonacci number as well from the most recent swing low, then great. We haven't quite got if it didn't close above the 0.618, unfortunately. So we can't quite call that Fibonacci, although it's close. It's very close. Had that low test closed on the 0.618 or indeed above it, then we could say we had a confluence of reasons to go long here, and it would have been a very nice trade indeed. And with this example here of Swissy, if you draw a trend line support, then quite often this correlates to trend line resistance. So what quite a few people do is they copy their level of trend line support like so, and they see if there's symmetry with the cyclicity on the top side. Here we don't have it. However, what we do have is, even though it's not symmetrical, we do have points where we've got an alignment here. So we've got a channel, an upward moving channel. And upward moving channels are very good. They give the element of predictability. It's like, for example, if you went long here and it did go long in your favor, then it would make a lot abundant sense to get out in advance of this swing high if you wanted a higher probability, lower reward outcome. However, if you wanted to go for a higher high and go for a lower probability, higher reward outcome, then it would make abundant sense to get out at points of price action intersecting with this trendline resistance like so, if there are no significant numbers in the way. I know in this case with Swissy you've got parity in the way, so I think you've got every reason to get out before this huge great level here. However, if we didn't have parity and this was just an arbitrary currency pair, then you could be forgiven for just wanting to take it to a higher high. But as we just mentioned, don't worry too much about trend lines. I mean, they're great if you have them, great if they line up with another technical reason or factor. However, don't let them rule your trade completely. You can see here that horizontal levels rule the day. They always have, they always will. They correspond to price directly, i.e. what levels banks and institutions are buying and selling at, whereas trend lines are a lot more subjective. They are psychological lines in the sand, which quite frankly differ visually from different people to the next person. And we did the exercise when we ran a boot camp and a live trading day, where you got people on the same currency to draw the horizontal levels and then the trend lines. There were about 10 people who took part in this exercise. And of course, people got the horizontal levels right, more or less. But when we got round to the trend lines, we saw that every other person in the room had different angles, different trend lines. One guy had about 4 on, the other guy had about 15 on. And certainly, when you've got that level of ambiguity in the market, you can reasonably say, well, is this kind of self-perpetuating, self-fulfilling move we're looking for really going to happen if every participant in the market has a different idea as to at what point the price action intersects with this trend line? So just remember, horizontal levels is where the action is at, as opposed to the vertical levels. Well, that concludes our chapter, module if you like, on trend lines. Happy trading.